If you opened a SEP-IRA back in January and you're now hearing about the solo 401k, the Roth bucket, the participant loan, the fatter contribution at lower income, and you're wondering if you missed your window for 2026, the honest answer is probably not. But the clock is louder than you think. Every month you sit on a CP instead of a solo 401k at $100,000 of net self-employment income. You're leaving about $24,500 of tax-advantaged room on the table for the year, based on the 2026 IRS limits published in Notice 2025-67. That's not a rounding error, that's a house down payment over a decade. And here's the part almost nobody tells you before you sign the SEP paperwork at Fidelity or Vanguard, the form you almost certainly used to open it. Form 58305 SEP has a line in it that quietly prohibits you from running another qualified plan in the same tax year. So the mid-year switch isn't really a switch. It's a compliance move with a specific order of operations, and if you do it in the wrong order, you create a plan integrity problem that's a pain to unwind. Let's walk through exactly how it works, because there's a clean version of this and a messy version, and the difference is basically one afternoon of paperwork. First, the money math, because this is the part that convinces people to actually do the switch, instead of thinking about it for another 6 months. In 2026, both the SEP-IRA and the solo 401k share the same ceiling. The Section 441 defined contribution limit is $72,000, up from $70,000 in 2025. Same roof. The IRS also raised the compensation cap used to figure contributions to $360,000 for 2026, up from $350,000. So on paper, they look identical. They are not identical. The SEP is employer only, capped at 25% of compensation. The solo 401k lets you wear two hats. The IRS literally uses that phrase on their one participant 401k page, meaning you contribute as the employee first, up to $24,500 in elective deferrals, and then as the employer on top, up to 25% of compensation, until you hit that $72,000 ceiling. Run the numbers on $100,000 of net self-employment income. A SEP-IRA at that income gets you roughly $18,600 in contributions. A solo 401k at the exact same income gets you roughly $43,100. More than double. Same money in the door, more than twice the tax shelter. And that's before we talk about the $8,000 catch-up if you're 50 or older, or the $11,250 super catch-up. Secure 2.0 carved out for ages 60 through 63. The SEP offers zero catch-up. Zero. Your bracket and filing status obviously shift the after-tax value of all this, but the room itself is just bigger in the solo 401k, full stop. Now the part that trips people up. You opened your SEP at a mainstream custodian. Vanguard, Fidelity, Schwab, doesn't matter which. They almost certainly handed you a Form 5305 SEP. It's the standard. It's free. It's also restrictive in a way the sign-up flow doesn't advertise. Read the fine print on that form and you'll find language saying, the employer, that's you, cannot maintain any other qualified retirement plan for any tax year in which contributions are made under this SEP. Translation: if you put a single dollar into your 5305 SEP for 2026 and then open a solo 401k for 2026, you've technically violated the terms of your own SEP. The fix isn't scary, but it has to be deliberate. My take? Don't try to run both plans in 2026. Pick a lane. Either you make zero SEP contributions for 2026 and go all in on the solo 401k, or you finish 2026 in the SEP and open the solo 401k for the 2027 plan year. There is a third path using a non-5305 prototype SEP that allows coexistence, but almost nobody actually has one of those. And if you had one, you'd know because you'd have paid a TPA to draft it. Assume you're on a 5305 unless you can prove otherwise. Here's the clean sequence I'd run if I were sitting at your kitchen table. Step 1. Stop making SEP contributions for 2026 immediately. If you've already made a small SEP contribution for the 2026 tax year, talk to your custodian about characterizing it as a corrective distribution before your tax return is filed. This is doable. It's just annoying. Step 2. Open the solo 401k. Which brings us to the deadline, and this is where the entity type matters more than anything else in the whole conversation. If you're a sole proprietor or a single-member LLC taxed as a sole prop, the IRS lets you establish the solo 401k all the way up to your business tax return deadline, which for 2026 is April 15, 2027, or October 15, 2027 with an extension. Generous. If you're an S-Corp or C-Corp, the rules are brutally different. You must have the plan document signed and adopted by December 31, 2026, or you lose the ability to make any employee deferrals for 2026. All $24,500 of that deferral room, gone. You can still do an employer profit-sharing contribution up to your extended return deadline, but the deferral piece is a hard December 31st wall. I've watched S-Corp freelancers miss this by literally 2 days because they thought they had until April. They didn't. Step 3 is the rollover, and this is the part everyone panics about for no reason. Rolling your existing SEP-IRA balance directly into your new solo 401k is a non-taxable trustee-to-trustee direct rollover. The IRS rollover chart is explicit on this. The once per 12 months rollover rule that applies to IRA rollovers does not apply here. This is an IRA to employer plan move. Different bucket, no limit on how much you move or how often. It's not a Roth conversion. You're not creating a tax bill. And the amount you roll over does not count against your $72,000 contribution limit for 2026. That last point matters because I still see people online claim you'll use up your contribution room by rolling. You will not. The rollover and the New Year contribution are separate transactions in the IRS's eyes. Just make sure it's coded as a direct rollover, not a distribution. If the check gets cut to you personally, you have 60 days and a headache, and 20% may get withheld. Trustee to trustee. Say those words to the custodian. There's a piece of this that broke in 2026 that most YouTube videos on solo 401ks haven't caught up to yet. And if you're 50 or older, it applies directly to you. Starting this year, Secure 2.0 requires that any 401k catch-up contributions from participants whose prior year W-2 wages from that employer were $150,000 or higher have to be made on a Roth basis, after tax. Which sounds fine, except a lot of the cheap or free solo 401k plan documents out there, the ones the big brokerages hand out, do not support Roth contributions at all. Fidelity's free solo 401k historically has been one of those. If your plan document doesn't allow Roth and you're a high-earning 50-plus freelancer, paying yourself W-2 wages above $150,000 through an S-Corp, you can't make catch-up contributions in 2026. Not you shouldn't. You literally cannot. Here's what I'd do. When you shop for a solo 401k provider, filter for Roth support first, loan feature second, and low cost third. In that order, providers like Carry, My Solo 401k Financial, and Employee Fiduciary all offer Roth-enabled documents. Fidelity added Roth to their Solo 401k recently. Confirm the version you're being offered supports it before you sign. Quick aside, I get asked constantly whether it's worth paying for a prototype plan when the brokerage version is free. For most sole proprietors under about $150,000 in net income, no, the free plan is fine as long as it has Roth. If you want participant loans, if you want the mega backdoor Roth through after-tax voluntary contributions, if you want to roll in an old employer 401k, then yes, pay the $200 a year for a real document. I help freelancers figure out the money side of going solo, and the number one regret I hear isn't, I paid too much for my plan. It's, I opened the free one, hit a wall 2 years later, and had to restart the whole thing. One more thing worth knowing before you pull the trigger, because it's the objection I hear most often. But the SEP deadline is more forgiving. I can wait until October to fund it. True. The 2026 SEP contribution deadline runs all the way to your extended return, as late as October 15, 2027. That flexibility is real. It's also not worth $24,500 of missing deferral room, and $8,000 missing catch-up, no Roth bucket, no loan option, and no path to the mega backdoor Roth. The solo 401k is simply the better vehicle for a freelancer with no employees. The SEP made sense in 2001 when solo 401ks barely existed as a product for the self-employed. EGTRA changed that in 2002, and the SEP has been the wrong default for most freelancers ever since. Honestly, I think the only reason SEPs are still the default anyone recommends is that they take 5 minutes to open online and solo 401ks take about 40. That's it. That's the whole reason. A quick reality check on individual variation, because I'd rather you catch this now than in April. If your net self-employment income is under about $30,000, the difference between a CP and a solo 401k in raw contribution dollars is small enough that the setup effort may not be worth it in year one. The value shows up when your income grows. If you have any employees other than a spouse, the solo 401k is off the table entirely, and you're into SEP or simple or a real 401k with a TPA. And if you're already deep into the year with sizable SEP contributions already made for 2026, the cleanest path is often to finish 2026 in the SEP and start the solo 401k fresh on January 1st, 2027, rather than trying to unwind mid-year. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this saved you from a plan integrity headache, subscribe. The whole channel is built for people doing this without an employer's HR department. And if there's a specific 1099 or solo retirement question you want me to unpack next, drop it in the comments. I read them and I pull topics straight from there. Next week, I'm breaking down the mileage log the IRS actually wants to see at 72.5 cents per mile for 2026, the format, the app I use, and the mistakes that get logs thrown out in an audit. See you then.